The spreadsheet changed everything. Not a complicated financial model, not some sophisticated algorithm, a single page with 4 numbers that I updated once a month. That simple practice revealed something most financial advice completely obscures. Retiring early isn't complicated. The industry wants you to believe it requires advanced strategies, timing markets perfectly, selecting winning investments, earning extraordinary income, sophisticated tax maneuvers, an arsenal of techniques that most people could never master. This complexity serves the industry, not you. It creates dependency on advisors. It sells courses and subscriptions. It makes financial independence seem like a destination only experts can navigate toward. I bought into this narrative for years. I read every book, studied every strategy, analysed investments obsessively. I thought mastery of complexity was the path to early retirement. Then I met someone who retired at 47. Not an executive, not an entrepreneur who sold a company, a teacher who earned a modest salary her entire career. She had no sophisticated strategies. She couldn't explain modern portfolio theory. She had never heard of most alternative investments I considered essential knowledge. What she had was something simpler. She knew her numbers. 4 specific numbers that she tracked religiously. That tracking, not complexity, had made her retirement possible decades before her peers would stop working. That conversation began my real financial education. The education that actually worked, unlike the complicated approaches that mainly consumed time and created anxiety. Today I'm sharing what I learned. How to retire 10 to 20 years earlier than traditional timelines without complicated strategies. The 4 numbers that matter. How to track them. Why tracking itself produces the results that complex strategies promise but rarely deliver. This approach works regardless of income level. It works regardless of investment sophistication. It works because it addresses what actually determines retirement timing rather than what the financial industry profits from discussing. Let me show you the simplicity on the other side of unnecessary complexity. The foundation of early retirement is understanding that timing markets, picking winning stocks, and earning exceptional income matter far less than most people believe. These factors matter somewhat. Better investment returns help. Higher income provides more raw material to work with. I'm not dismissing them entirely, but they're not the determining factors. I've watched high earners remain trapped in employment indefinitely because other variables worked against them. I've watched modest earners achieve financial independence decades early because they understood what actually drove the timeline. The real key is knowing and regularly monitoring a few critical financial numbers, not dozens of numbers, not elaborate dashboards tracking hundreds of data points, a handful of metrics that together determine when work becomes optional. This sounds too simple to people who've absorbed the complexity narrative. They want sophisticated solutions because sophisticated problems seem to demand them. Financial independence feels like it should require advanced knowledge and complex approaches. It doesn't. The math that determines retirement timing is straightforward. The behaviors that accelerate that timeline are basic. The monitoring that keeps you on track is minimal. The first number that matters more than anything else you could focus on is your savings rate. Savings rate is the percentage of your take-home pay that you invest for the future. Not save in a checking account. Invest in assets that generate returns. This single number predicts retirement timing more accurately than income level, investment returns, or any other factor. A high savings rate makes early retirement almost inevitable. A low savings rate makes it nearly impossible regardless of how much you earn. Consider the math. Someone saving 10% of their income will work for decades regardless of other factors. Someone saving 50% of their income will achieve financial independence in a relatively short period regardless of starting point. The relationship between savings rate and working years is not linear. It's exponential in favour of higher savers. Going from 10% to 20% savings doesn't just cut your working years in half. It reduces them by more because you're simultaneously building assets faster while keeping expenses lower. The lower expenses mean you need less total wealth to sustain your lifestyle indefinitely. Most people have never calculated their actual savings rate. They know vaguely that they contribute to retirement accounts. They have a general sense that they're saving something, but the specific percentage remains unknown. This vagueness prevents progress. Without knowing the number, you can't improve it deliberately. Without tracking changes over time, you can't see whether your financial position is strengthening or weakening. When I first calculated my savings rate honestly, the result was humbling. I considered myself financially responsible. I contributed to retirement accounts. I had some investments. I assumed I was doing well. The actual number was around 12%. At that rate, I was looking at a conventional retirement timeline. All the complexity I'd studied, all the sophisticated approaches I'd tried to master, had produced mediocre results because the fundamental driver wasn't where it needed to be. Knowing the number allowed changing the number. I began tracking monthly. I found ways to increase the rate incrementally. Over time, that 12% became 20, then 30, then higher. Each increase accelerated the timeline substantially. This single metric, tracked consistently, provides more retirement planning value than elaborate projections and complex investment analysis. The calculation requires using take-home pay rather than gross income. Many people make the mistake of calculating savings rate against gross salary. This distorts the picture because gross income includes money you never actually receive. Taxes, FICA, benefits deductions, money that flows elsewhere before reaching your actual control. Measuring against net pay gives an accurate picture of money actually available to direct toward your future. It shows what percentage of the resources you actually command you're choosing to invest versus consume. Include retirement contributions when calculating both sides. The money flowing into your 401k or IRA is part of your take-home compensation, even though it doesn't pass through your checking account. It appears in both your income and your savings, giving accurate representation of your actual savings behavior. Some people exclude retirement contributions from take-home pay, then calculate savings rate only on what remains in their checking account. This produces misleadingly low savings rates for people whose retirement contributions are substantial. The goal is truth. What percentage of the money that constitutes your actual compensation are you directing toward future financial independence? The answer to this question matters. How you arrive at the answer matters less than ensuring accuracy. I track gross income, all deductions, and net pay. Then I track all money going toward investments, including retirement accounts, brokerage contributions, and any other asset accumulation. The ratio of total investment to total available compensation is my savings rate. This comprehensive tracking prevents self-deception. It's easy to feel virtuous about finances when using calculations that flatter your behavior. Accurate calculation reveals reality, which may be more or less encouraging than imagination suggested. The second number that determines retirement timing is your annual spending. Your expenses shape how much you need to save and how long it will take to reach financial independence. A person who spends $50,000 annually needs to accumulate far less than a person who spends $150,000 annually. This seems obvious, but has implications most people don't fully absorb. Every dollar of recurring spending requires roughly $25 of invested assets to sustain indefinitely. That monthly subscription costing $15, it requires approximately $4,500 of retirement assets to fund forever. That upgraded car with a payment $300 higher requires approximately $90,000 additional dollars to sustain. Viewing spending through this lens transforms how purchases feel. The new expense isn't just the monthly amount, it's the investment portfolio required to generate that monthly amount perpetually. Reducing spending accomplishes something powerful. It simultaneously decreases the target you're aiming for while increasing the resources available to reach that target. Unlike increasing income, which is subject to diminishing returns through taxes and lifestyle inflation, decreasing spending provides dollar-for-dollar improvement to both sides of the equation. Tracking spending requires honesty that many people resist. They track obvious categories while ignoring others. They account for monthly bills but overlook periodic expenses. They remember large purchases but not the accumulation of small ones. Both recurring and irregular purchases must be tracked to get accurate pictures. Annual expenses, periodic maintenance, occasional splurges, the car repair that happens unpredictably but inevitably, the home expense that appears periodically, the gift-giving that clusters around certain seasons. I track spending by reviewing all accounts monthly, every credit card, every checking account, every payment method. I categorize spending to understand where money actually goes versus where I assume it goes. The assumptions about spending are usually wrong. Most people who attempt this tracking discover that certain categories consume far more than they believed. The category they considered modest is actually substantial. The category they never thought about represents significant outflow. This discovery isn't about judgment or deprivation, it's about awareness. Knowing where money actually flows allows conscious decisions about whether that flow reflects your actual priorities. Someone might discover they spend $3,000 annually on something they genuinely value. That's fine. The spending aligns with priorities. Someone else might discover they spend $3,000 annually on something they barely notice. That's an opportunity. Those dollars could redirect toward financial independence without meaningful sacrifice. The relationship between tracking and behavior deserves specific attention. People who check their financial situation frequently make better financial decisions. This pattern appears consistently in research and observation. It operates similarly to monitoring habits in other domains. The person who weighs themselves regularly at the gym maintains better eating and exercise discipline than the person who avoids the scale. The awareness itself influences behavior even without any additional intervention. When you know your savings rate is being calculated monthly, you naturally consider purchases differently. The purchase doesn't just affect today, it affects the number you'll record at month's end. That number connects to your timeline for financial independence. The chain of consequence becomes visible. When you know your spending will be totaled, you're less likely to make thoughtless purchases. The total will reflect every decision. Each choice accumulates into a number you'll face. I didn't understand this connection initially. I thought tracking was just measurement, something you did to know where you stood. I didn't realize tracking itself would change where I stood by changing my behavior. The act of recording forces confrontation with reality. The record accumulates into evidence that either supports or undermines your claimed priorities. Claiming to prioritize financial independence while recording spending patterns that contradict that claim creates dissonance that tends to resolve toward alignment. People who never track never face this confrontation. They maintain comfortable narratives about their financial behavior without evidence testing those narratives. They can believe they're doing well because nothing forces them to define what doing well actually means. Monthly tracking provides accountability without outside judgment. You're accountable to yourself. The numbers reflect your choices. The trajectory shows whether those choices align with your stated goals. This accountability is surprisingly effective. I found my own tracking more motivating than any external pressure could be. The numbers are mine. The progress or lack of progress is mine. The responsibility is mine. This ownership creates engagement that externally imposed systems rarely achieve. The third number to track requires distinguishing between investable assets and total net worth. Total net worth includes everything you own minus everything you owe. Your house, your car, your furniture, your possessions. All assets and all liabilities combined. This number matters for some purposes. But it misleads for retirement planning because much of what contributes to net worth cannot fund your retirement. Your home is worth something. But unless you sell it and move somewhere cheaper, that value doesn't generate income to cover expenses. It's illiquid. It's also necessary for living. You can't spend it while continuing to live in it. Your car is worth something, but you likely need it for transportation. It's not available to fund retirement. It's actually depreciating while requiring ongoing costs. Personal property, household goods, even valuable collections, these contribute to net worth, but don't fund retirement living expenses. They're not generating returns. They're not providing cash flow. They're not working to support you. Investable assets are what matter for early retirement calculations. This category includes investment accounts, retirement accounts, brokerage holdings, rental properties generating income, and other assets that can produce returns to fund your life. Only assets that can generate returns should be counted toward early retirement goals. This provides honest assessment of actual progress toward financial independence, rather than inflated comfort from owning things that can't help when you stop working. I made this mistake for years. I felt wealthy because my total net worth seemed impressive. House equity, vehicle value, possessions accumulated over time. The total was substantial. Then I calculated investable assets specifically. The portion actually available to fund early retirement. The number was far smaller than the net worth figure that had been providing false comfort. That honest calculation changed my behavior. I stopped accumulating possessions that contributed to net worth, but not to financial independence. I directed more resources toward investable assets that would actually support retirement. The goal isn't minimizing net worth or avoiding all possessions. The goal is clarity about what actually contributes to your retirement timeline versus what just makes the overall number bigger without helping you stop working earlier. The fourth number to calculate and track is years to financial independence. This metric combines everything discussed into a single output. It tells you when you can retire based on your current savings rate, spending level, and investable assets. The calculation begins with determining your target retirement portfolio. The simplest approach multiplies your annual spending by 25. If you spend $50,000 annually, your target is $1,250,000. This is based on the 4% withdrawal rule, suggesting you can withdraw 4% of your portfolio annually with high probability of the money lasting 30 plus years. Some people adjust this multiplier for more conservative or aggressive assumptions. Multiplying by 30 provides more cushion. Some FIRE approaches use lower multipliers, accepting higher withdrawal rates. The specific multiplier matters less than having a consistent target to track against. With target portfolio established, you can calculate years to reach that target given your current savings rate and investable asset base. Online calculators handle the compound interest math. Input your current investable assets, annual investment amount, and expected return rate. The output shows years until you reach your target. This number reveals the direct relationship between behavior and timeline. The person saving more reaches the target faster. The person spending less needs a smaller target and reaches it faster. Every improvement in either variable produces visible acceleration. Watching this number change over time provides motivation that abstract goals cannot match. Knowing that you're 13 years from financial independence feels different than knowing you're saving for retirement someday. The specificity creates tangibility. The trackability creates accountability. When I first calculated my years to financial independence, the number was depressing. Based on my then current savings rate and spending, I was looking at decades more of mandatory work. The timeline stretched toward conventional retirement age despite my intention to retire early, but the calculation also revealed leverage points. What if savings rate increased by 5%? The timeline shortened meaningfully. What if spending decreased by 10%? The timeline shortened further. The math showed exactly how behavior changes translated into timeline changes. This visibility transformed motivation. I wasn't just saving abstractly for the future, I was purchasing specific reductions in working years. Each improvement in the underlying numbers showed up as fewer years of mandatory employment. Tracking monthly revealed compound interest working in my favor. Each month, the investable assets grew. Each month, the projected growth on those assets accelerated. Each month, the years to independence number declined by slightly more than 1 month, because investment returns were contributing alongside new savings. This acceleration is invisible without tracking. People who don't calculate this number don't see the compound growth reducing their timeline. They contribute without awareness of the accelerating force working alongside them. The 4 numbers together create a complete early retirement tracking system. Savings rate shows what percentage of available resources you're directing toward financial independence. This is the primary behavioral driver. Annual spending shows what lifestyle your target portfolio must sustain. This determines the size of the target. Investable assets shows current progress toward that target. This is the accumulation that will eventually fund your retirement. Years to financial independence shows when you'll reach the target. This is the timeline that the other numbers combine to produce. Tracking these 4 numbers monthly provides everything needed to navigate toward early retirement. Not dozens of metrics, not elaborate financial dashboards. 4 numbers that together capture the essential dynamics. The tracking itself need not be complicated. A simple spreadsheet works, a note on your phone works, even a paper notebook works. The format matters far less than the consistency of recording. Each month, record the 4 numbers. Review the trajectory. Note whether each number moved in the right direction. Identify what caused any negative movements. Consider what changes might improve the next month's numbers. This review takes perhaps 30 minutes monthly, not hours of analysis, not complex calculations. Brief review of 4 metrics and consideration of what they reveal. The simplicity is a feature, not a limitation. Simple systems get maintained, complex systems get abandoned. A tracking approach you actually follow for years produces results that sophisticated approaches abandoned after months never can. People who ask about my early retirement approach expect complicated answers. They want to know about specific investments, tax strategies, optimization techniques. They assume the outcome required advanced methods. The actual answer disappoints them initially. I tracked 4 numbers. I tried to make each number better over time. I continued tracking for years. The compound effects of consistent small improvements accumulated into significant results. This answer seems too simple, but its simplicity is precisely why it worked. I could sustain the approach. The monitoring remained manageable. The behaviors became habitual. The results compounded. Someone following a complex system might produce better results in theory, but theories don't retire. Actual portfolios built through sustained behavior do. The simple system followed consistently outperforms the complex system abandoned eventually. Making improvements in these numbers doesn't require dramatic life changes. Small adjustments sustained over time produce powerful results. A 1% improvement in savings rate seems insignificant, but that 1% sustained for years accumulates substantially. And improvements tend to compound on themselves. 1% this month, another percent next month. Gradually, the savings rate has transformed. Spending reductions work similarly. You don't need to revolutionize your lifestyle. You need to find the expenditures that don't provide proportional value and redirect those dollars. Most people have spending categories that could decrease without meaningful quality of life reduction. I found recurring subscriptions I'd forgotten about, services I no longer used, insurance I was overpaying for, habits that cost money without providing much enjoyment. Identifying and eliminating these didn't feel like sacrifice. It felt like clearing dead weight. The tracking itself surfaces these opportunities. When you see spending totaled by category, inefficiencies become visible that invisible money flows conceal. The redundant service that seemed minor is clearly a waste when you see 12 months of payments totaled. Income improvements help too, though they require ensuring the additional income flows to savings rather than spending. Raises and bonuses tend to disappear into lifestyle inflation unless deliberately directed elsewhere. Tracking makes this visibility possible. You can see whether the raise improved your savings rate or simply elevated your spending. This cycle of tracking, identifying opportunities, making adjustments, and tracking again creates continuous improvement without requiring dramatic intervention. Each cycle produces modest improvement. The cycles accumulate into transformation. The teacher who retired at 47 didn't have extraordinary income or extraordinary discipline. She had consistent tracking and continuous modest improvement over a couple of decades. That consistency, not any exceptional moment, produced her result. Most people underestimate what consistency produces because they overestimate what intensity produces. They imagine dramatic transformations, major sacrifices, heroic efforts. This imagination paralyzes. The effort required seems too great. The actual requirement is much gentler. Small, consistent attention, regular modest improvement, patience while compound effects accumulate. This is achievable. This is sustainable. This is what actually works. I want to address the psychological transformation that tracking produces beyond the mechanical benefits. When you know your numbers, you feel differently about financial decisions. The anxiety of not knowing gives way to the clarity of understanding. Even if the numbers reveal challenges, knowing them feels better than the vague worry that comes from ignorance. I carried financial anxiety for years before I started tracking. I worried about whether I was doing enough without knowing what enough meant. I wondered if I was on track without knowing what track I was trying to be on. The vagueness itself generated stress. Tracking resolved this. Even when the numbers were worse than I wanted, knowing them was better than not knowing. I could see exactly where I stood. I could identify exactly what needed to improve. I could measure exactly whether my actions were working. This clarity transforms relationship with money from anxious to empowered. The numbers might indicate a long road ahead, but you know the road. You know your position on it. You know what it takes to travel faster. The mystery that generates anxiety becomes the information that enables action. Financial independence stops being an abstract dream and becomes a concrete destination. A destination you can see. A destination you can measure progress toward. A destination that gets closer with each passing month of consistent action. This psychological shift matters as much as the mechanical benefits of tracking. Feeling in control changes behavior. Understanding the dynamics changes decisions. Seeing progress sustains motivation through the years of accumulation required. People abandon financial improvement efforts when the effort feels pointless or progress seems invisible. Tracking makes progress visible even when slow. You can see the numbers moving even when the movement is gradual. The visibility sustains effort that invisible progress cannot. I've watched people transform their relationship with money through nothing more than consistent tracking. They didn't discover some secret strategy. They didn't receive windfall income. They simply began watching the numbers that mattered and making decisions accordingly. The watching itself changed what happened because it changed how they thought about financial decisions. Every choice connected to the numbers, every number connected to the timeline, every month provided feedback on whether choices were helping or hurting. This feedback loop creates improvement without requiring willpower for every decision. The system provides guidance, the numbers provide accountability, the trajectory provides motivation. The individual just has to maintain the tracking and respond to what it reveals. This is why simple systems outperform complexity for most people pursuing financial independence. Complex systems require more expertise to implement. They demand more time to maintain. They create more opportunities for error. They overwhelm rather than empower. Simple systems work with human nature rather than against it. They're maintainable indefinitely. They provide clear signals rather than confusing noise. They enable consistent action rather than perfect optimization. The 4-number system I've described is not optimal in theoretical terms. A more sophisticated approach might incorporate additional factors, might adjust for various scenarios, might optimize aspects that the simple system ignores. But theoretical optimization that requires unsustainable effort produces worse outcomes than simple approaches that remain consistent over years. The person tracking 4 numbers monthly for a decade will outperform the person who attempted complex optimization and abandoned it after 18 months. Financial independence isn't a sprint where peak performance matters. It's a marathon where sustained pace determines outcome. Simple, sustainable systems produce marathon success. Complex, demanding systems produce burnout and abandonment. I've tried both approaches. The complex approaches taught me interesting things. They provided intellectual stimulation. They made me feel sophisticated. The simple approach built wealth. It produced the early retirement trajectory that complex approaches never did despite their theoretical superiority. The 4 numbers, tracked monthly, small improvements over time. That's the actual system, not complicated strategies, not market timing, not stock picking, not elaborate tax maneuvers, not sophisticated investment vehicles. Knowing the numbers that determine your timeline, monitoring those numbers regularly, making each number incrementally better, continuing this practice for years. Write in the comments what your current savings rate is. If you don't know, commit to calculating it this month. The calculation itself begins the transformation. Share this with someone who believes early retirement requires complexity they can't master. The simplicity might be exactly what they need to hear. The permission to pursue financial independence without sophisticated knowledge might unlock their path. The teacher who retired at 47 didn't have special knowledge. She had consistent practice. She tracked the numbers that mattered. She made those numbers better over time. That's available to anyone, regardless of starting income, regardless of current financial situation, regardless of investment sophistication. Know the numbers, track the numbers, improve the numbers. That's how you retire 10 to 20 years early, without complicated strategies. It's simpler than you were told. It works better than what you were told. Start tracking today.